I'm Charlotte McLeod with the Investing News Network, and here today with me is Larry Lepard, sound money advocate and managing partner at EMA. Thank you so much for joining me today.
Oh, it's an honor. It's really fun to talk to you, Charlotte.
Yeah, so it's our first time talking. I'm also really excited to have you here.
Yeah.
I wondered if you could give just a quick overview of yourself and your work.
Yeah, sure. Well, more recently, I run a fund, and the fund focuses on gold and silver mining companies with a piece of Bitcoin as well. I think these are both two different forms of sound money, and I've been a sound money advocate for quite some time now. Probably what triggered me, I mean, somebody say, how did you become radicalized for sound money? Uh, I think the 2008 financial crisis was really a big turning point in my investing career. Prior to that, I'd been a technology investor and venture capitalist and just kind of a traditional investor. And when I saw what the central banks did in response to the great financial crisis, where they let off the bankers, they printed a ton of money, it was an eye-opening event for me. And I thought to myself, okay, things have really changed here. These people are going to debase these currencies, and I need to figure out an investment strategy that will work well in a world of central banks that are going to print money. And so I pivoted, and that's what I've been doing since '08. Now, it's confession, it's taken longer than I thought, right? '08 was quite some time ago, but it's certainly, we're now at the point where things seem to be accelerating, right?
Right. Okay. And I had a chance to watch your presentation yesterday.
Sure.
We're here at the New Orleans Investment Conference. I think my main takeaway was, you're telling us the Fed can't continue much longer along this
Correct.
path. And I think many people agree. Certainly here many people agree on that note. But I found you gave kind of a more clear picture of what it would actually look like, this economic doom loop that you see coming.
Yes.
So I wondered if you could
Yeah,
talk
I'd
a
be
little bit
happy.
about
I'd be
that.
happy to do it because I think that's an important thing to understand. Because this isn't just an emotional view that, oh, gold's going to win and we're on the right side. There's actually a mathematical explanation for what's going on here, and that is at a very simple level. I showed a chart that shows total debt and the growth of total debt, and then I showed total growth in GDP. And the GDP is what produces the interest to service the debt. And if the debt grows much more quickly than the GDP, eventually you get to the point where the GDP can't support the debt and something has to give. Either the debt's going to collapse or there's going to be inflation. And let me describe how that happens because I talked about this in the presentation. It's what I call the economic debt doom loop. And so here's what happens. 2 years ago, the US federal government spent about $350 billion a year on interest expense. It's because interest rates were lower. Interest rates have started, we've now got inflation. We all know that's big. And interest rates have started going up as a result of both inflation and the Federal Reserve policy. So the inflation is making all the debt. We have $31 trillion on the level of federal debt. So the inflation is making that debt more expensive to carry. So we used to pay 300 and some odd billion a few years ago for interest. Now we're at a run rate of about 750. And if we go to 4% across the whole spectrum of debt, we're not there yet. Some of the longer debt's cheaper, but we'll be at 1.2 trillion, which adds another 500 billion in expenses. And the point I'm getting at is, so the interest expense in the federal debt is paid out of the federal deficit or the federal budget. And the budget, we collect taxes and then we have expenses, right? And what I'm saying here is, as this interest cost gets larger and larger, it's eventually going to be larger than Social Security, larger than defense, and it's going to make the budget deficit bigger. That's the important point to recognize. So then you've got a bigger budget deficit. How do you finance the budget deficit? You sell more debt. Well, by selling more debt, what does that do in a fixed amount of buyers? It pushes the rate of the debt up. So now the interest rate's higher on more debt. What does that do? That increases the deficit. See where I'm going here? It's a doom loop. The worse things get, it cycles around, right? As the interest costs go up, your deficits get bigger, you sell more debt, the cost of the debt gets higher, and then interest costs go up again. This is how currencies fail. This model has been seen in other currencies. It's not been seen in G7 currencies since Weimar back in 1922. But this is seen in Argentina, in Venezuela, in Zimbabwe. I mean, countries get into a problem when they take on too much debt, they run deficits, and they start printing money to cover the deficit. And pretty soon everybody realizes, you know what? They're never going to be able to stop. They're going to just have to keep printing and printing. And then the next button, light that goes off in the head, light bulb that goes off in the head, they go, oh, if they're never going to stop, the inflation's going to get worse. And eventually there's something called Gresham's Law. I was an economist in England a long time ago, who basically said good money chases out bad, right? And so everyone thinks if my money is continually losing value, when I get paid, I need to take the money I'm being paid and buy something that's not losing value. And of course, the natural choices are gold and silver, and to a degree, Bitcoin, right? because you can't print gold, you can't print silver, you can't print Bitcoin. So that's kind of the model that I see unfolding. And we're at the stage now where it's really starting to quicken and happen. And I say that because I think there's a very important event. Some of your listeners may have focused on it, some may not have. And that is what happened in the Bank of England in the last couple of weeks is a really big deal. The English 10-year gilt was just kind of, the interest rates were going up and then suddenly they really shot up. The Great British Pound was kind of trending down and then suddenly it just plummeted. And so suddenly here's a big G7 country, England, starting to look like Venezuela, right? And so the English central bank reacted, the Bank of England reacted and said, oh, no, we're not going to do that. We're going to print, and they put in all these policies to try and stop this. But by the way, all those policies involve printing more money, which back to my debt doom loop, it's only going to make it worse. The thing that I would say is that the United States is England, we just don't know it yet. What happened to them is coming here. It's just we're a little behind them because we're bigger and the dollar's a reserve currency. And Brent's right about his milkshake theory. It's going to take a while to hit the United States, but it's coming. It's definitely coming. That's kind of how I see it.
Yeah, so you gave us kind of this clear look at what it will be like, and you also gave, I found, a clearer timeline than we usually get for things like.
Well, and I caution, I could be wrong.
True. But I think it was 3 to 6 months, 18 months at the longest
Yep.
before it starts seeing this come to a head. So yeah, maybe we can talk a little bit more about that. Like how have you defined that?
Well, I think we all know the things to watch, right? Watch the interest rates and watch the government deficits. Those are the two big indicators. Watch the currencies as well. If as long as I've got a laser focus on the U.S. 10-year because that's kind of the reference rate for a lot of debt in the world, and so the U.S. 10-year is knocking on 4%, and I think 4% is too high. I think at 4% our budget's going to blow out. But the rate it's been going, it could be at 5, not that far out. So I think as you see, the markets, it's funny. It's like the Fed and these people who are running these institutions, they say things and they make policies and they say how it's going to be, but then the market reacts. And what happens when the market does what they don't want it to do? They don't want any of this. Trust me. They wish everything would just calm down and interest rates would stay low and all the people would just say, oh, no, inflation's going to come down. We believe you. It's not a big problem. The problem is we saw this morning with a hot inflation print, inflation's not coming down, right? And the bond market's not getting stronger. In fact, it's getting weaker. And so, that's really the critical. Those are the critical things to watch. Now, as I say, if suddenly the 10-year catches a bid and trades in a lot lower, or if suddenly we get some really soft inflation prints, it's possible. I could be wrong in the timing, but I think the overall trend is pretty well developed. And that's the other thing I think I said in the presentation. I would emphasize to everybody here. These things aren't perfect straight lines. There's zigzaggy nature to it. In fact, gold investors are frustrated right now. I know I'm frustrated right now. We had a couple of gold stock investors. We had a couple of really good years in 2019 and 2020, but then they kind of got things under control. The deficit came in a bit lower. They stopped the overt printing of money, or they announced they were going to stop the overt printing of money, which they've kind of started to do, and so things have calmed off for a few years. And so, it's not unusual in a period like the 70s. You saw these impulsive waves of inflation, and then you saw it back off. Then you see another impulsive wave, and you saw it back off. But until the fundamental problem gets solved, we've got an inflation problem and we've got a debt problem. And solving it, in my opinion, is going to involve some kind of a reset where we go back to a sound money standard.
Okay, and can you also describe what a reset would be?
Well,
I find that very
yeah, I don't know. We haven't been through one in a long time. The last one was when Roosevelt grabbed the gold and devalued gold by 70%. I don't think they're going to grab the gold. I don't think they're going to grab Bitcoin. Let me say this. If I was an enlightened leader, what I would say is something along the lines of, folks, we've really made a mistake in relying on fiat currency and printing money. We've allowed ourselves to get into an enormous credit bubble that's now bursting. We need to go back to a form of sound money so that people can plan and so that prices don't fluctuate all over the place like crazy. We're going to do a reset. We're going to create a new dollar. It's going to be backed by gold. It's going to be priced at $20,000 an ounce. We'll exchange the dollar for gold, which means they're basically stopping all forward printing. And, 5 old dollars equals 1 new dollar. And, Effectively what it would do, and everything through the economy would reprice, and effectively what it would do is it'd be a big write down. All the people who hold debt would get hurt, because it'd be a big write down of old dollars would lose value, obviously, compared to new dollars. But it'd be better probably than the alternatives, which are kind of a crack up boom or hyperinflation or just a 1929 style collapse, because it would be planned, everyone could look at it, everyone could see it, and we could trust this new sound dollar going forward. Having studied a lot of hyperinflations in the past, the one conclusion I came to was they're obviously all horrible, but what's really surprising when you read the histories is that when a hyperinflation occurs, as long as there's not a war, there's always that risk. As long as there's not a war, the people are still there, the factories are still there, everything's still there. What happened is just the wealth got redistributed. And if they went back to sound money, like post 1923 in Germany, they went back to sound money and they elected a nut, but the sound money solves the problem. So the solution to this issue is we need sound money, right? And if we go back to sound money, the problem will go away. The unfortunate and necessary adjustment is that to get from here to sound money, somebody's going to get hurt. But I would submit to you that there's no way, given the system they built here, there's no way somebody's not going to get hurt. And what we ought to try and do is do it in a controlled and professional manner and try and make it as fair across so that everyone gets hurt an equal amount, as opposed to a complete collapse where some people get really destroyed. And so that's kind of how I view a monetary reset. Now, to answer your question, do I ever think they're going to do it? No. There's no chance of this, right? This would involve politicians being forward-thinking and not self-interested. And so sadly, I think they're going to run the car right into the wall. And at that point, we're going to have a problem. And then they'll do a reset. Yeah.
Okay. And can you do something like that at a country level? It feels like you need greater participation than just one.
Perhaps, but I think it's yes, the U.S. Yes, I mean each country will make their own vote, but and maybe some countries will try it. I don't know. The U.S. could do it. I mean, as the reserve currency today and the biggest country in the world, the biggest, having the U.S. having the reserve currency, yes, we could do it, and the rest of the world would follow. Having said that, there are other countries that are kind of moving in that direction, right? I mean, if you look at kind of what Saudi Arabia is doing, if you look at what Russia's doing, I mean, there are other countries that are trying. Some of these BRICS countries are talking about trying to move more towards a commodity standard, as opposed to, I mean, what the dollar has done and the way that we have taken advantage of having a reserve currency, people understand that, and that's part of the problem, right? Everyone understands it, so.
Okay, so despite all of these things that are going on in the world, you told us yesterday that we're actually pretty lucky. So because we have the opportunity right now to get in precious metals and
correct,
so,
correct. I mean, I think I said it to the people in this room because sadly, I think that you look at the society, and I mean, there just aren't many people out there who really understand what's going on. I mean, there's a bunch of us, and it's growing constantly. But I think a lot of people are just very unaware that the fundamental problem is this unsound money issue. And when this reset occurs, when this hyperinflation or high inflation occurs, there are going to be a lot of people who aren't prepared for it. And everyone in this room, I think, is aware of the issue, studying the issue, thinking about the issue. And I don't think anyone has any full understanding. And I'm not saying I do either, but I believe that it's going to be kind of stunning what's going to happen. I mean, this can happen pretty quickly. And there are going to be some really big winners, and there are going to be some really big losers. And I believe, because I think the issue is unsound money, I believe those people who are storing their wealth in unsound money are going to be the losers. And I think those of us who've chosen to buy and invest in things which are more sound in their nature are going to be very, very big winners, much bigger. I think we're going to surprise ourselves, even.
Yeah, and I think at this event people are aware, as you said, of the situation. They want to be positioned, but I'm still seeing questions about is now the time to get in? Will it get worse for gold? Should I wait?
Oh, yeah, it always could. I mean, that's no, right? I mean, it's like yes, it always could. But I think the correct answer is on all these things is your dollar cost average over time, and and you also consider your time frame. I mean, obviously, I have no idea where the gold price will be in a month, 3 months, 6 months, but I'm very confident that 2 years from now, 3 years from now, it'll be much, much higher because of the trends I see developing. And if I saw these trends reverse, I might change my opinion. But right now, they're not reversing; they're actually accelerating. I mean, consider what happened in 2021. I mean, it took the GFC. It took 3 years to print 3 trillion. 2021 they printed 3.5 trillion in 18 months, right? I mean, it's just like bam. They. I mean, it's and as I say, this Bank of England thing is a big deal. And the interest rates. I mean, I had a chart in my presentation which I showed, the 2-year rate. Do you remember that chart? I mean, it was, the 2-year U.S. government 2-year bond had an interest rate of like 40 basis points as recently as like 18 months ago, maybe 12 months ago. It's at 4%. I mean, it's gone up like 8 times, right? I mean, it looks like an arrow straight up. I mean, that doesn't happen. I mean, I think Tavi or Brent had a very good chart this morning, which showed the Japanese yen. The Japanese yen is down, this year it's down 20%. I mean, that doesn't happen in emerging countries, much less a G7 country. I mean, to those of us who've been, I'm 65, I've been in the financial markets since my 20s. To those of us who've been in the financial markets and watched this stuff for a long period of time, we're seeing these move, and it's just like, wow, this is really, really big stuff. And that's why I can deduce with confidence that things are happening, things are breaking. I mean, you don't see these kind of moves unless there's something much larger going on. At least that's what I've noticed in history. Yeah.
Okay, and maybe we can look a little bit more closely at the fund and how it breaks down. So you've got gold,
Right.
silver,
Right.
Bitcoin, and then within that, the companies are broken down into their
Correct. Right. So yeah, I'm a big silver bull, I'm a big gold bull, I'm a big Bitcoin bull. They're all going to work in varying degrees and varying ways. So we're about probably in the companies. So we're about 15 to 20% Bitcoin, the coins, and some companies that are developing Bitcoin applications. The balance is in gold and silver mining. That's probably 70% gold, maybe 60% gold, 40% silver. I love silver. It's got more optionality. And the thing about silver that's nice is there are no above ground stores. I mean, it gets used, so we have to keep mining it. I mean, a lot of gold out there, and then within that there are buckets. Within the gold and silver mining companies, there are buckets, and the 3 buckets everyone knows them are they're the producers, which have positive cash flow. Great thing about those companies, they generally don't need to raise money, and they're not likely to go out of business. Gold mining business, I mean, I would say this to your listeners, gold mining business is a tough business, right? You're breaking rocks and you got to replace what you break. It's hard. It's really hard. And even the best management teams, best companies occasionally make mistakes and blow up. So, if you're just entering into the space, you want to be in the larger producers with positive cash flow. Okay. And they may not have 20x upside potential, but they're not going to blow up and go out of business. Okay. Right. And then the next step down is the developers. These are people who have a deposit and they're trying to figure out how to turn it into a mine. That's a very risky area, but in turn, if it works, you can make 10, 15 times your money pretty easily here. But recently there've been a lot of capex overruns, and there are all kinds of issues there. There's getting the mine up, getting it running, getting the process. There are issues, and then of course the third and the sexiest area, but also the most risky, is the drill stories, right? And these are this is Snowline, who goes out and they drill some fabulous holes, and the market cap goes up 10x overnight. The problem is that it's very hard to figure out which one's going to be Snowline, and Snowline's a long way from having a profitable mine. I mean, they've got to do a lot more drilling, and there are a lot of issues from here to having cash coming out of the door. So, but having said that, we do participate in some of the drill stories. I mean, we try to look at kind of the best of breed in each of these 3 buckets, again, we're always looking for kind of the best risk reward trade-off, and I call it asymmetry, and what I mean by that is just I go into all these things thinking I don't want to do this if I don't think if I'm right I'll make 3 times my money. If I'm really right, I'll make 10 times my money, because I know some of them I'll be wrong. And on the ones I'm wrong, I'll probably lose all my money. So if I take 10 names and I lose all my money on 1 or 2, that's, okay, so I'm down 10 or 20% there. But if the other 70% on balance goes up 3, 4, 5x, I'm doing fine. They've covered the losses. So it's kind of a numbers game. I mean, the worst mistake any gold stock investor can make is like to buy one company. Say, I love this company, I think it's going to work. Well, I tell you, I've had companies I absolutely love. I was sure were going to work, and they didn't. And then I've had other ones where I thought, well, this is kind of interesting, and it might work, and they were home runs. So it's hard to tell. It's really hard to tell. Even if you know the management team, even if you know the deposit, even if you're a geo. I mean, everybody in this industry, everybody in this hall will tell you, we all get it wrong sometimes. But what you're trying to find is good bets, good risk reward. So that if it works, you're going to make a lot of money.
Yeah, I think that's a theme that I've kind of been seeing come up at this event is, you've got to look beyond your one thing that you like and be a little bit diversified.
Yeah.
So if you could talk, just as we're wrapping up, a little bit more about the Bitcoin angle, because
Oh, sure.
yeah, I was just surprised. I told you before we started talking, I didn't expect to hear
Yeah.
Bitcoin at this event.
Yeah.
Got a pretty big.
Well, I'm one of the people who believes in both gold and Bitcoin. In fact, yeah, well, that's not so rare. But yeah, last year I found about half the people raised their hand when I asked if they own Bitcoin. I mean, a lot of gold. I mean, look, gold guys get Bitcoin. I mean, we all get the money is broken issue. Okay, a lot of gold guys don't get Bitcoin because they think, well, it's not tangible, I can't touch it. But Bitcoin's a technical innovation, and it is sound money in the sense that the ledger is immutable. And there are only, as we said, as I was talking to you before we started, the thing about Bitcoin that's most interesting to me is it's the only commodity in the world that doesn't respond to higher prices. So think about that. If the price of Bitcoin goes to 100,000, we're not going to make any more of them. The amount we're going to make, the amount that are being mined from now until we hit 21 million, it's fixed. And then when we're done at 21 million, that's it. There's no more. So, think about that. It's actually a deflationary currency because we've got a fixed amount of them. And if you look at, kind of on a Malcolm Gladwell adoption curve basis, we're maybe at 10% of the world is kind of aware of and owns Bitcoin. And, 7 billion people in the world, what, 150 million maybe own Bitcoin? Fixed supply at 21 million, 150 million people own it. The other people are going to over time. I mean, I see the thing that gets me so excited about is I see more and more people using it all the time. I mean, Nigeria, El Salvador, there are all these use cases that are coming up. And as more and more people use it, then, this fixed supply, there's only one thing the price can do, and that's go up. They gotta pay more to get it. And so, I sincerely believe, I mean, Bitcoin's at 20,000 now, down from 70. Obviously, a lot of people, feeling terrible about that, but I don't. I think Bitcoin goes on the next run. I think it goes to 200,000. I think in 5 years it's at 1 million. So, to me, it's great optionality if you can handle the drawdowns and you want to either dollar cost average it or try and buy it on a severe drawdown. I mean, sadly, what happens is a lot of people FOMO into, and this happens with gold stocks too, right? I mean, I had a lot of investors come at me remember 2020, gold stocks were ripping. I had all kinds of investors throwing money at my fund. I said, guys, it's getting a little frothy here. You're welcome to do it, but you could also dollar cost average. And of course, since then, it's kind of trickled down a little bit. I mean, you've got to, in these kinds of volatile commodity-like things, I've found over the years that you do the best when you buy terror, which is kind of what everyone's terrified, and you sell greed. And I can assure you that when gold goes to 2,000, it's ripping to 3,000. All these stocks are going up fast as can be. Money will come flowing into this area, and the same thing will be true of Bitcoin. Bitcoin will be 100,000 and rising, and money will be flowing into Bitcoin, and that's all good. But I would just suggest that there's a very easy way of looking at this. You look at what the prices are compared to the 200-day moving average, and when things start to get too extended above that 200-day moving average, they're not cheap anymore on gold or Bitcoin. And right now, both of them are way below the 200-day moving average. Bitcoin, in all the history of Bitcoin, it has only been as cheap as it is compared to its moving average now 5% of the time. So in other words, 95% of Bitcoin's life, it's been at a higher multiple of its moving average. So you could buy some Bitcoin right here, and I think in 3 years you'd be very glad you did. But of course, it doesn't feel that way right now because everyone's looking at saying, it was 70, went to 20, it's going to die. And that's natural psychology, right? I mean, you go to the supermarket. I mean, I see filet mignon on sale. I'm like, I want more. But investors look at this stuff and they're like, oh, filet mignon's $50. Give me some of that. I want more. I mean, you got to buy them when they're cheap. That's how you got to do it. So.
Okay, well, thank you. Thanks for going through that. And once again, I'm Charlotte Powell with the Investing News Network, and this is 30.